Welcome to the Explainer. Today, we're going to tackle a financial product that a lot of people have heard of, but honestly, very few truly understand. I'm talking about the annuity. Now, it's designed to give you income in retirement, but its complexity can be a real stumbling block. So our mission today is to break it all down for you.
So here's our game plan. We're going to start with the big retirement puzzle that makes these things so popular in the first place. Then we'll get into what an annuity actually is, check out all the different flavors they come in, and put the two big ones head to head. And of course, we'll wrap up with some really crucial mistakes you'll want to avoid.
Okay, first things first, before we even talk about the solution, let's really understand the problem that annuities are trying to solve. And it's a question that's probably on the mind of anyone who's saving for the future.
I mean, this is the big one, right? This is the fundamental question that millions of people are wrestling with as they get closer to retirement. The goal isn't just to have a big pile of money, it's about how you turn that pile into a reliable, steady paycheck that, you can't outlive.
And this challenge, it's only getting bigger. By 2040, about 1 in every 5 Americans will be 65 or older. At the exact same time, traditional pensions, those guaranteed paychecks for life from your employer, they're practically an endangered species. So what does that mean? It means the job of creating a retirement paycheck is falling squarely on our shoulders.
And that brings us right to the annuity. At its very core, it's a tool designed specifically to create that income stream we're all looking for.
So, stripped of all the jargon, what is it? An annuity is basically a contract, a deal you make with an insurance company. You give them a chunk of your savings, and in return, they promise to pay you back with a steady stream of income in the future. It's a way to turn that pile of cash into a predictable paycheck. Here's a great way to think about it. You buy insurance for your house in case of a fire, right? Or for your car in case of an accident. Well, an annuity is a type of insurance against the financial risk of living a really, really long life. The industry calls this longevity risk. You're literally insuring yourself against outliving your money. Okay, but here's where things get a little tricky. Annuity is a super broad term for a huge menu of different products. So the best way to get a handle on them is to break them down by what you're actually trying to do. What's your financial goal? Let's start with goal number 1. Let's say your main objective is just to grow your nest egg, maybe with a little bit of a safety net for your principal. This is for when you're still in the accumulation phase of your life. These products are all about growing your money. For example, a multi-year guarantee annuity or a MYGA works a lot like a bank CD. It gives you a fixed interest rate for a set period. Others, like fixed indexed annuities, are pretty interesting. They link your potential earnings to a market index, like the S&P 500. You get some of the upside, but, and this is the key part, your principal is protected if the market goes down. All right, but what if you're already retired? What if you need that income stream to start, right now? Well, there's a whole category of annuities designed just for that. These are built to start paying you back almost right away, usually within a month to a year after you buy it with a single lump sum. It's all about converting that nest egg into immediate cash flow. And finally, we've got a category for the planners out there. The goal here is to lock in an income stream that won't start for years, sometimes decades. You're basically creating your own personal pension plan. These products are all about maximizing that future payout. You give the insurance company money now, and in exchange, they promise you a predictable, guaranteed income that might start in 10, 15, or even 20 years from now. It's all about protecting your future self. So even though there are all these different types, most of the conversations you'll hear about annuities really boil down to one critical choice: the classic trade-off between the safety of a predictable return and the growth potential you get from being in the market. And this, right here, is the fundamental choice you have to make. With a fixed index annuity, you absolutely cannot lose your initial investment if the market tanks, but your potential gains are going to be capped. On the flip side, with a variable annuity, your growth potential is technically unlimited, but you're also exposed to all the market's risks, and you could lose money. Let's break this down even further. So, with a fixed index annuity, that FIA, your principal is safe. That's a huge selling point, but your upside is limited. With a variable annuity, or VA, the sky's the limit for growth, but your principal is right there on the line, exposed to market losses. And one more thing, VAs almost always have higher fees to cover all the costs of managing the investments inside them. Okay, but just understanding the product type, that's only half the battle. Annuities are incredibly complex, long-term contracts, so it is absolutely critical to know about the common traps people fall into. And Investopedia really hits the nail on the head here. This complexity can lead to some really costly mistakes. It's so easy to miss some little detail buried in the fine print that can have a massive impact on your retirement income down the road.
Okay, here are the 4 big ones. First, not understanding the costs. You have to look out for high fees, but especially for what are called surrender charges. These are huge penalties for taking your money out early. Second, misreading what guaranteed actually means. It's a guarantee from the insurance company, not a guarantee you'll beat the stock market. Third, forgetting about your heirs. Without a specific death benefit, any money left could just go straight to the insurance company. And finally, overlooking inflation, which is the silent killer that can eat away at the value of fixed payments over time.
So how do you make a smart decision? First, you have to do your homework. Check the financial strength rating of the insurance company. Think of it as the report card from a firm like AM Best. That rating tells you how likely it is they'll be around to pay you in 30 years. Second, make sure this product actually fits into your bigger plan. And finally, really consider talking to a fiduciary advisor. That's a professional who is legally required to act in your best interest, which is very different from a salesperson working on commission. So in the end, is an annuity a tool for guaranteed security, or is it a costly, complex mistake? Well, the truth is, it's neither inherently good nor bad. It's a tool, and whether it's the right tool for you depends completely on your personal goals, how well you understand the contract, and if it's the right piece for your personal retirement puzzle. Thanks for joining us for this explainer.